Arizona's housing empire is crumbling. Right now, 5 desert cities are witnessing a market meltdown unlike anything since 2008. Prices slashed 25%. Insurance premiums tripled. Inventory exploding faster than builders can cut prices. Bloomberg analysis shows several Arizona metros display correction indicators more severe than pre-crash 2007 levels. Is your equity vanishing overnight? We're counting down the 5 Arizona cities where housing markets are collapsing hardest in 2026. This is full-scale wealth destruction happening in real time. Hit subscribe to Housing Intel and smash that bell so you never miss intelligence like this. Number 5. Sedona. Sedona was supposed to be untouchable. Nestled among Crimson Canyon walls, this mountain sanctuary attracted wealthy retirees and second-home buyers paying premium prices for desert luxury. 2026 is rewriting that story brutally. According to Zillow data, median home values crashed nearly 20% in 24 months, dropping from $950,000 to approximately $760,000. Luxury estates now linger for months, even after 6-figure price cuts. Active listings tripled year over year. 3 forces drive the collapse. First, insurance costs exploded. Annual premiums jumped from $4,000 to over $10,000, sometimes $15,000 in wildfire zones. Second, short-term rental regulations strangled investor demand. New ordinances cut Airbnb occupancy below 50%, turning profitable vacation homes into money-losing liabilities. Third, tourism revenue is softening, cracking the boutique economy. Local families earning the median income of $68,000 are priced out entirely. Property taxes climbed even as values fell. Maintenance costs for historic homes average $1,800 monthly before mortgages. Developers abandoning projects mid-construction. Lenders won't finance luxury condos in markets showing sustained deterioration. For a city symbolizing exclusivity, 2026 delivers harsh lessons in vulnerability. Number 4. Scottsdale. Scottsdale built its identity on prestige. For decades, this desert oasis represented Arizona luxury. Championship golf, sprawling estates, designer shopping, unmistakable wealth. 2026 proves even affluence can't shield against market forces. NAR reports show home prices plummeted 18% year over year. Median prices fell from $690,000 to $565,000. But price alone doesn't capture the crisis. Ownership costs are crushing buyers. Luxury insurance exploded from $6,000 annually to over $15,000. HOAs levy special assessments ranging $12,000 to $35,000 per household for infrastructure repairs. Property taxes surged 30% since 2020. High-end listings in DC Ranch and Silverleaf sit vacant over 200 days. Sellers slash prices by $200,000 without generating offers. Cash buyers and corporate investors completely exited. Days on market quadrupled in premium segments. Homes above $800,000 stagnate 8 months or longer. Scottsdale's brand built on confidence now defines uncertainty and desperation. Realtors describe standoffs between sellers clinging to yesterday's valuations and buyers demanding discounts reflecting today's reality. With mortgage rates near 7% and insurance unstabilized, Scottsdale's correction has room to run. Number 3. Chandler. Chandler earned its Silicon Desert reputation. Semiconductor plants, tech campuses, and innovation employers created booming ecosystems attracting high-earning professionals nationwide. master-planned communities transformed farmland into modern prosperity symbols. 2026 shatters that image. Redfin data shows prices collapsed 16%, falling from $620,000 to $520,000. Luxury developments in Ocotillo and Fulton Ranch showcase unsold inventory sitting vacant 90-plus days despite aggressive incentives. Tech slowdown hit exceptionally hard. Major manufacturers froze hiring and delayed expansions. Remote work policies driving migration reversed as companies mandate return to office. Migration waves reversed in demographics. Builders offer unimaginable incentives: $75,000 reductions, paid closing costs, rate buydowns to 5.5%, $40,000 in upgrades. Desperate measures signal profound inventory problems. Construction permits fell 38% year over year. Boom-era projects sit half-finished. Rental markets soften with vacancy rates above 8%, forcing landlords to cut rents. Energy costs punish. Summer electricity bills exceed $400 monthly for average homes. Combined with $5,500 insurance premiums and rising taxes, total ownership costs doubled in 4 years. Chandler learns speculation-fueled growth creates fragility. When momentum stops, correction is swift and merciless. If this breakdown opens your eyes, subscribe to Housing Intel right now. Number 2. Phoenix. Phoenix wasn't just Arizona's boom epicenter. It was the national poster child for pandemic real estate mania. 2019 through 2022 seemed unstoppable. Values doubled. Bidding wars erupted constantly. Out-of-state buyers from California, Pacific Northwest, and Midwest treated Phoenix like sunshine paradise. 2026 delivers reckoning. Census Bureau migration data shows the surge stalled completely. Median prices fell 15%, dropping from $530,000 to $450,000. Inventory doubled from 11,000 to 22,000 active listings. Bidding wars vanished, replaced by price-cutting competitions. High rates, insurance shocks, and property tax increases froze demand. Median homes costing $1,700 monthly in 2020 now demand $3,000 plus after 7% mortgages, tripled insurance, HOA fees, and utilities. Builders across Goodyear, Surprise, and Peoria sit on thousands of unsold units. Construction once sold during framing now sits completed and vacant for months. Subdivisions planned for 500 homes scale back to 200 or abandon entirely. Rental markets cracked. Vacancy rates climbed to 9.2%, highest since 2012. Landlords rent at losses or liquidate. Foreclosure filings spiked 23% year over year. Phoenix's correction won't be dramatic crash. It'll be grinding monthly erosion of equity and confidence. By year-end, pandemic boom wealth will evaporate, leaving over-leveraged owners trapped in unaffordable, unsellable homes. Number 1. Buckeye. Buckeye, the cautionary tale defining Arizona's disaster. For years, Buckeye marketed as the future. Master-planned desert communities, affordable family homes, endless westward expansion promising decades of prosperity. Between 2019 and 2022, prices doubled from $210,000 to $470,000. Buckeye became America's fastest-growing city, a title developers wore proudly. That growth was quicksand. By 2026, freefall. Prices crashed 25%, some subdivisions 30%. Inventory quadrupled. Construction sites sit silent, surrounded by weeds. Model homes stand empty. For sale signs sun-faded. Builders offer staggering incentives. 60,000 discounts, covered closing costs, rate buy-downs, 50,000 in upgrades. Nothing works. Buyers vanished. The problem is structural overbuilding meeting infrastructure collapse. Developers built faster than population sustained, betting on infinite migration. That bet catastrophically failed. Arizona's water crisis compounds disaster. Buckeye relies on groundwater and Colorado River allocations, both severely strained. Developments promised parks, schools, shopping that remain unfinished due to funding gaps. Buyers feel deceived and walk from contracts. Property values in half-built neighborhoods fell 30%, trapping owners in subdivisions never reaching completion. Pre-construction investors abandon deposits rather than close on homes worth less than contracts. Rental demand collapsed as workers relocate to Phoenix employment centers. Buckeye isn't correction. It's structural collapse, revealing what happens when speculation outpaces sustainability and optimism becomes delusion. 2026 makes Buckeye America's clearest warning. Hype-built growth doesn't slow down. It implodes. From Sedona's luxury meltdown to Buckeye's implosion, Arizona's boom officially ended. This isn't temporary dip or normal cycle. It's full-scale reset driven by insurance shocks, water scarcity, interest rate reality, and evaporated speculative demand fueling unsustainable growth. Billions in equity vanishing. Families stretched during booms face suffocating costs and cratering values. Overbuilt builders desperately unload inventory. Investors treated Arizona like profit machines now flee silently. Armed with this intelligence, you make strategic decisions. Avoid carnage. Wait out chaos. Position for opportunities when dust settles. Knowledge shields you in volatile markets. If this delivered value, smash that like button. Subscribe to Housing Intel for weekly data-driven real estate intelligence cutting through hype delivering truth. Comment which Arizona city shocked you most. We read every one. See you next breakdown. Because sometimes knowing where not to invest is the most profitable decision ever.